Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
European capitals reacted with shock to President Trump's abrupt turn against Ukrainian President Volodymyr Zelensky, seeking simultaneously to reassure Kyiv that it has the continent's backing while trying to appeal to Washington. Now, President Trump yesterday embraced the Kremlin's narrative, denouncing Zelensky as a dictator, his word. Trump warned in a social media post that the Ukrainian leader had better move fast to reach a deal with Russia, or he's not going to have a country left. Meantime, one more thing to layer on top of this. The U.S. signaled that sanctions relief for Russia could be on the table in talks over the war in Ukraine. Earlier today on Bloomberg, U.S. Treasury Secretary Scott Bessent said that the U.S. is prepared to either ramp up or take down penalties based on the Kremlin's willingness to negotiate. He also talked about what the administration seems to say is a misstep by the Ukrainian president.
I think President Zelensky, unfortunately, escalated and has put some daylight between.
How did he escalate?
A lot of his remarks in Munich, I thought were inappropriate. President Zelensky, when I met with him, assured me that he'd be signing the minerals deal in Munich. He has not. And look, the real purpose here, and I think it's turned into kind of this media circus, that President Trump had a very elegant plan, and it was bring the Ukrainians closer to the U.S. Let's do this economic deal. And even Karl Rove in the Wall Street Journal this morning approves of it, that the U.S., with greater economic interest in Ukraine, provides a security shield. So the sequencing of what was going to happen was bring the Ukrainians closer to the U.S. Through economic ties, convince the American people and the American public, get them on side, and then tell the Russians, go to the negotiating table with a very fulsome message that if we need to, we will take sanctions up.
Well, what about tapping the Russian frozen assets, some $300 billion? Would you force your European counterparts to not just have them frozen, but actually tap them? Trump talks about repaying the American taxpayer. Shouldn't Russia be a part of that?
Well, what's happening now is they are being tapped. So the returns from
the interest,
the returns from the freezed asset pile is going to pay the Europeans. You know, what's very important to understand here is that everything the U.S. has done to date, the American people, the American taxpayer, is grants. The Europeans, roughly half of what they've done are loans, and the runoff from the frozen assets is being used to repay European loans.
Have you communicated that to the Europeans, that you're upset with them?
What's that?
Have you communicated to the Europeans that you're upset with them?
I think Vice President Vance did a pretty good job in Munich.
Do you think they understand that the United States is running a deficit of north of 6%, close to 7%, and that the budget for defense is north of $800 billion? Do you think they understand the gravity of the moment in the United States, the U.S. perspective?
Look, I think that they understand that President Trump, during his first term, this term, Vice President Vance, and the entire security apparatus have told them that many of the countries are deficient in their NATO spending, and they need to come up.
All right, that, of course, was U.S. Treasury Secretary Scott Bessent earlier on Bloomberg Surveillance, on Bloomberg Radio and TV, along with Jonathan Farrow, Anne-Marie Hordern, and Lisa Abramowitz, the co-hosts of Bloomberg Surveillance. Well, monitoring all of this, continuing to report on the Russia-Ukraine war and what an end might look like, is Bloomberg News International Affairs columnist Marc Champion. He joins us now from London. Marc, good to have you here with us. The U.S. Treasury Secretary said the president is committed to ending this conflict very quickly. It's now 3 years old and still going. There are two players in that war, and yet Ukraine seems to increasingly be cut out. Is that a fair assessment?
Absolutely. I mean, you can ending wars is easy if one side surrenders and capitulates, and the other side gets what they want. And the reason that this, war hasn't come to a settlement yet is that the two sides have, remain really far apart, with President Putin still making, demands. Reportedly, for example, in Riyadh, Russian demand was repeated that NATO should go back to its 1997 borders, so that would mean Poland, etc., would have to leave NATO. So these are still very sort of extensive demands on NATO, let alone Ukraine. And the Ukrainians obviously have been fighting a war to prevent that, because they understand that it would mean that they no longer had a state, an independent state. And the Russians have been clear that that is their intent. So it's very difficult unless one side capitulates. And I think what President Trump has basically done is to identify that he has a lot of leverage with one side, because it's very dependent on American support and financing and weapons, and very, much less leverage with the other. He's also, I think, identified that there's a lot more to be gained, by cutting a deal with the Russians. They have more to offer, larger economy, all that sort of thing. He did make this proposal to the Ukrainians. It was, in fact, originally Zelensky's idea. The Treasury Secretary omitted to say in his interview was that when Zelensky got the actual details of the U.S. proposal, what it says is that the Ukraine should hand over 50% of all its natural resources, infrastructure, ports, etc., 50% of revenues to the U.S. in perpetuity. And there was nothing in the deal about security guarantees and that the kinds of things that Zelensky was trying to get. So it was a deal that was clearly designed to be rejected.
Marc, one thing that I think is notable about this entire conversation is the role of a Treasury Secretary being part of this negotiation. How should we think about that?
Well, I mean, American Treasury Secretaries are unique in the world in the sense that one of the most powerful foreign policy tools and weapons of coercion that the United States has is the Treasury and its sanctions apparatus. They are extremely powerful, and it makes a lot of sense that they should be involved. The Secretary talked about lifting sanctions. Of course, both the EU and the US have imposed sanctions on Russia. But essentially, if the US were to lift sanctions, that would be the end of it, because the EU simply doesn't have the kinds of depth of enforcement personnel and expertise that the U.S. has. It doesn't have the U.S. dollar as a point of leverage, and it has no experience whatsoever with enforcing secondary sanctions. So it doesn't surprise me at all that he's involved.
I think what's also fascinating and intriguing about your column is that this isn't about an end to the war, but about the United States and President Trump negotiating a reset with Russia. Again, your view, but is it because, explain that, I guess I want to ask you, and then is it because there is so much more potentially that the U.S. has to gain? Is it business interests? Is it geopolitically? Is it in terms of maybe keeping nuclear war at bay? Is that it? And if so, is that such a bad thing?
Well, the Secretary of State, Marco Rubio, after the Riyadh meeting, said very clearly that, there was enormous opportunities to be had, both geopolitical and economic, for the United States in securing this deal. What I was trying to say is that if you look at this, the Trump administration's approach in terms of them trying to get what the Europeans want and the Ukrainians want, which is the best possible deal to retain Ukraine's status as a sovereign state, retain as much land as it can, etc. If that is the goal, then nothing that President Trump has done makes sense, because he handed over some of the most important demands that the Russians have made before talks have even begun. And in fact, in Riyadh, setting up teams to begin talks on a ceasefire was just one of the outcomes, and not the one that was first listed. The first one that was listed was to restore diplomatic relations and economic relations between Russia and the U.S. That's also why Ukraine and Europe were not at the table, because it wasn't a deal that was primarily about them. The difficulty for Ukraine and for the Europeans is that once that's understood, then Ukraine and its ceasefire, they become just a lesser tool in a wider deal, and they are both something that the U.S. has some leverage with over Russia, because Russia wants control over Ukraine, but it's also if Ukraine stands in the way and won't give won't agree to a deal and to the terms that are being imposed, then it becomes the obstacle to the wider agreement that President Trump is looking for. It just makes a lot more sense to me if you look at it in those terms.
Marc, just about a minute left. What was the signal that you think it sent to the world and sent to the U.S. that the president yesterday called Zelensky a, quote, dictator?
Very much, in terms of that framing, what he has identified is that Zelensky and Ukraine are the problem at this point, as far as he's concerned. So he is adopting the sort of Kremlin narrative in order to try and undermine Zelensky and weaken him and make him understand that he has to play ball or things will only get worse.
Unbelievable. Yeah, just interesting. Marc, thank you so much. Glad we could chat with you about your column today. Marc Champion, he is international affairs columnist for our Bloomberg Opinion team, joining us from London. Again, you can check out his column. You can find it on the Bloomberg terminal and at bloomberg.com/opinion.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Not an update either for sales of the giant retailer Walmart. Shares down around 8% at one point earlier in the session, the most in more than a year, after it forecasts lower than expected profit for the full year, signaling that even the world's largest retailer is not immune to risks in the broader economic environment.
That's right. And Walmart's CFO acknowledging, quote, uncertainties related to consumer behavior, something we were just kind of talking about with our own Jody Laurie. Uncertainties related to consumer behavior and global economic and geopolitical conditions. That from the Walmart CFO. Keep in mind, this comes just days after retail sales signaled an abrupt pullback by consumers. So let's get to it with more on Walmart's business, what it may say about the U.S. consumer spending environment. With us is Emily Cohn. She's Bloomberg News consumer team leader right here in studio. So Emily, walk us through this latest update on Walmart and why investors are so concerned.
Yeah, so it wasn't altogether a bad report. Fourth quarter sales were actually strong. Stock is down, though, on a lower than expected profit guidance for the full year. And you nailed it. The theme of the call with analysts today was uncertainty. We just heard that word over and over and over again. And that's consumer sentiment. That's tariffs. That's everything we're reading about in the news, just making it really hard for these companies to project what's going to happen.
Is that the issue, though? It's that it's difficult to project. They don't know what's going to happen, but because of that, they're just setting out the worst case scenario here?
Yeah, I mean, this wasn't worst case by any means. Like, Walmart has historically given conservative outlook to start the year. Last year, they actually offered the same exact outlook, 3 to 4%. So it's definitely in line. It's conservative. We read analyst Bobby Griffin say they're taking a conservative approach on near-term investments. We saw the cost of the acquisition of Vizio appear. That's still hitting the bottom line for Walmart this year. So what typically happens with Walmart is they raise their guidance early on in the year. So it's not worst case scenario. It's
they start the year with a cautious outlook, right? Yeah. And then raise as we go along.
It's sort of like in line with expectations, but expectations are really high for Walmart. Their last year was their strongest stock performance since 1998. The stock is up 77%, although that will be lower over the last 12 months after close today. So expectations are really high.
Emily, I think what's also interesting is I remember, I feel like in the last quarter of last year, we were increasingly talking talking about, and Walmart pointed out that their consumer is also a higher end consumer.
Yes.
So when we are trying to get, if their higher end consumer is even maybe pulling back or they're concerned about that, that does make you wonder about consumer spending overall. If they're having potentially a tougher time, then you can assume everybody's having a tougher time.
For sure. So, I mean, one of the areas, the biggest area of growth for them right now in this last quarter was those people from those higher income households that are making $100,000 or more. So that makes me wonder, where are they gaining that market share from? Who's losing those customers? And that's what we'll be looking for. This is the start of big box earnings season. So we have Target coming up, Costco, Home Depot. We'll be trying to decipher that a little bit more.
Do we know how Target, or rather how Walmart, would be affected by tariffs? They get certainly some food from Mexico. I mean, you walk into a Walmart, it's going to be hard to find something in there that's not from China.
Yeah.
What's the way that they're impacted?
Yeah. A lot of produce is coming from Mexico. A lot of general merchandise is coming from China. And this isn't new to them either. I mean, China tariffs last time around with Trump hit them as well. But yeah, they are definitely exposed to China, as are a lot of their competitors.
Emily, I always think about, Walmart, they're massive, right? The world's largest. And, there's certain retailers that when something comes out of them, even if historically they're cautious at the beginning, it does make us stop and think. But as you said, it's just the beginning of the big box. Is there something Target might say, or who is it that might say something that says, all right, so maybe this is just the Walmart, the way they operate, and we'll get things better. Is there someone that can help shape the narrative here around retail?
Yeah, I think it'll be Target.
Okay.
Last quarter, we saw a pretty positive reaction from Wall Street after Walmart earnings, and then the complete opposite reaction after
Target's down almost 2% today.
Yeah, Target and Costco shares both fell immediately after Walmart reported this morning. So we'll be looking to see that. I mean, Target relies a lot on discretionary spending. You come into Target for one thing, and then you see a lot of other cute things, and you grab them, and those are the kinds of things that people are pulling back on right now. And if that shopper is not even going to Walmart if they're not even going to Target because they're going to Walmart instead, that's bad news for Target.
Does a report such as this, apart from Target, a report such as this from Walmart, make you rethink expectations for the entire sector for the current quarter?
For sure. Walmart is the bellwether of consumer spending.
What's the one we should be watching next?
I'm watching Target.
Yeah? Well, Home Depot, what is that going to tell us?
Home Depot has a lot of other factors too, weather, other types of spending.
I mean, I'm also thinking about the housing market.
Yeah,
and to
absolutely.
what extent, a dreary sort of outlook there
for sure.
Affects that company.
Yeah, you buy a new house, you're moving into a new house, you go to Walmart, Target, Costco, or to fill up on things. And if you're not buying a new house, you're not buying those things.
Yeah, and we have seen pressure. I'm just looking at, home builders today are up about 0.9%, just looking at what they're doing so far here in 2025, down about 4%. But again, we keep talking about...
yesterday they got hit because of Toll Brothers.
Exactly. But we do hear the conversation that if mortgage rates continue to stay high, sometimes it makes people say, okay, here's where we're settling. I'll get off the fence and do something and buy a home and then fill it with stuff. Others say, I'm still going to wait till maybe things go down. Emily, thank you. Appreciate the rundown on Walmart. Emily Cohn, she's consumer team leader here at Bloomberg News, joining us right here in our studio. As we mentioned, Walmart shares, they are definitely under pressure. Stock down now about 6.5%, so just shy of its worst levels of the day. If we take a look at the trade here in 2025 for Walmart, just up about 7.6%.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So this popped up on our radar today. Bloomberg opinion columnist Tyler Cowan, a professor of economics at George Mason. He's also host of the Marginal Revolution blog. He writes a column today that the U.S. economy may be heading towards stagflation. You know what that is. A combination of high inflation, high unemployment, which last occurred in the mid-1970s, so it's been a while. He notes that current inflation rates are 3% and may increase due to factors such as rising rents, wage growth, and also President Trump's trade policy, which could lead ultimately to higher prices. And Tim, our next guest, believes the U.S. economy can function perfectly well with inflation closer to 3%. We'll see if he has any caveats to that.
We've got with us Dan Genter, CEO of Genter Capital Management. He joins us here in the Bloomberg Businessweek studio. They've got about $7.25 billion in assets under management. Dan, good to see you. 3% inflation. We always talk about the Fed's target of 2%. It's a long story about why that target exists, but 3%, why do you think it's manageable?
Well, look, it's been manageable for a very long period of time, and 3% pretty well goes along with long-term population growth, frankly. So it kind of runs hand in hand that as you have that population growth, you're consuming more goods and services, and those prices tend to go up in line with that. That's not even taking into consideration if you have a 1% increase in productivity, which is normal, kind of throws you back into that 2% range when you're really looking at effective prices from disposable income. So long term, that's, in my opinion, a very, very manageable number. I mean, the significance of the number really becomes more of the Fed policy, their outlook, and the effect on interest rates. All right, because in a very simplified format, look, interest rates basically determine the cost of everything. It determines your cost of production. It determines your cost of financing. It determines your cost for the two biggest items for almost every American, which is their mortgage and their car loans. And so that's really going to be the key with regards to how fast do we go or how fast do we slow.
So interesting. Does it matter in terms of population growth? The aging, is it, if it's population growth where, I don't know, with an aging population, does that kind of change the outcome of things? I'm just curious, like the composition.
Yeah, Carol, it radically changes the consumption patterns.
Right.
Because, there's basically an economic phenomenon which has never been broken, and that is that you cannot break the baby boomer bubble. All right, that the baby boomer bubble made the Camaro, it made the Mustang, then it made the SUV, and now it's moving to Mercedes and BMW and vacation homes, and you can't fight it. It's just too big of a bubble of consumption. And now when you have a situation to where that generation, if you will, is largely leaving the workforce, then it's also become a very high consumption. But it's a different pattern of consumption. So they're not buying as many of the consumer durable goods. They don't buy as many refrigerators and other things that, in many cases drive some of the underlying pressures in inflation. But,
right.
But luxury goods and so on, go on a tear for that.
It's funny that you said that. I actually just wrote up a report that talked about luxury spending and how the luxury world has really kind of ignored what they call the so-called silver generation. And there's some stats from McKinsey that estimates almost half of the incremental growth in consumer spending this year compared with last year will be driven by those older than 50. And it's just kind of interesting to say not ignore it, certainly for the luxury space, but maybe more generally.
Well, look, the evidence, look at the end of last year. You look at fourth quarter spending with regards to retail goods and holiday spending. All right, and everyone was more or less flat. All right, the only one that had a big jump was Hermes. All right, so pretty well confirms that situation. You take the upper of the upper end, and they have plenty of money that's set aside. They have plenty of capital. Since they're major investors, they're also the major beneficiaries of the wealth effect from the stock market. Mm-hmm. So look, that part of the consuming public feels very flush right now.
Okay, that part of the consuming public is not going to be around forever, and I'm curious about what you think of the next generation, especially with regard to the way the economy has changed. We're now living in an economy where people are wondering, hey, what's going to happen to my job as a result of disruption caused by AI? How should we be thinking about that?
Well, look, there clearly is going to be a significant amount of disruption for certain sectors. There's going to be a number of service jobs, people that are basically answering the phones and giving client service over the phone for, various consumer products and so on. Look, a recording and a robot can do that. Certainly, and frankly, security jobs and things that robots can do, anything that you can automate, they're going to be able to take over. Now, there's going to be other jobs that it's not going to affect, and certain things that it's going to help.
Well, so let's say those folks who do get displaced by AI, by robots, what do they then go and do?
Well, hopefully what we're going to see is under the current administration, there's going to be a very big push, and there's also going to be a lot of support for recreating manufacturing jobs in this country. So what we see is that there's probably going to be a fall off in some of the low-end jobs. but there'll be an increase in some of the higher paying manufacturing and those types of jobs, more of what historically we call the blue collar jobs that we have in America, especially as we try to move tech jobs back, chip production back, power generation, oil production. We're trying to move everything back to make America great again. And those are actually higher paying jobs than the ones that are going to get displaced by robotics or electronics.
Higher paying jobs, higher salaries, I'm all for it. Higher wages across the board, but that also probably means everything costs a lot more. So is it potentially, it's not just a 3% inflation rate, but a lot higher?
Well, I don't know that necessarily is going to cost a lot more, because if you're increasing domestic supply,
right?
Okay, whether that be electronic energy or from oil and gas or manufacturing, if the supply is going up, then the pricing is not necessarily going to go up. So I think the concern about inflation is to say, where is the pivotal point?
But you talked about higher paying jobs, so that if AI replaces kind of those lower paying jobs and we have more higher paying jobs, I mean, that is a cost line certainly on balance sheets.
Absolutely. Then it depends on productivity. All right, because basically if the wages go up but the productivity goes up, then your cost of goods sold is not necessarily going to go up, and you don't have to pass that along to the consumer. Yeah. To me, a bigger issue, frankly, is that where do the lines cross between potential tariffs and then also taking those production jobs, back to America? Because if you're in a position where, we do end up in a trade war of some type, and you have a literally overnight increase of 15 to 20%, that's clearly inflationary if you can't come back and say, oh, we're going to now increase production domestically, to where it's going to supplement that and take the place.
Do you think we will end up in a trade war?
No, I don't.
Why do you think?
I think we will have trade wars with certain countries. I think our major trading partners that are going to have the biggest effect are negotiating as we speak. We're seeing everybody coming to the table. If it's going to be a tariff, it's going to be minimal. So I think the idea of saying, look, if you want to fight with us, we're going to have a tariff and we'll collect money from you, or you want to work with us, in essence, where you will take more of our goods and we'll take your goods, then basically that's advantageous to us, because now we're distributing more of our goods to other places in the world, and that's advantageous to domestic companies.
Well, it's just interesting, though, then, do you not think that the end of global supply chains is near? Do you think that ultimately, if we don't have a tariff war, then global supply chains kind of stay put and we don't necessarily bring everything back to the United States? And just got about 20 seconds.
Yeah, look, I don't think we'll ever get out of a global supply chain. I think that what we're going to see is that we want to be treated fairly.
Yeah.
We're not asking for special treatment, just, a level playing field. And then there's certainly some strategic from national security that we don't want to be where we're subject to all of our 70% of our chips being made in Taiwan.
All right, got to leave it on that note. Dan, great to get some time with you. Dan Genter, he is CEO of Genter Capital Management.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
We know that data centers used to power AI use a lot of energy. We spent a lot of time yesterday talking about where the power is going to come from.
Totally.
They're shoring up the grid in Texas. We talked to Zach Dow all about that. And then also Maria Korsnick over at the Nuclear Energy Institute about nuclear. Here's some context, Carol. Data centers use more electricity than most countries. Only 16 nations, including the US and China, consume more. If you take all the data centers together.
It's a lot.
It's a lot. It's a lot.
Yeah.
So it does raise the question, does the infrastructure exist to support these demands? And we're not just talking electrical infrastructure. We're talking about the way that computer systems and computer networks are built. Christina Shim was part of a group of executives who tried to answer that question today. She's Chief Sustainability Officer at IBM. She was joined at her panel at the Future Investment Initiative Institute in Miami by Sarah Fryer, CFO at OpenAI, and Rajit Nanda, CEO at DataVolt, among a few others. Christina joins us now from Miami. Did you answer the question today, Christina? Does the infrastructure exist?
I think you probably heard from most of us that there is definitely constraints on capacity at the moment. But the idea is more about how can we solution around that, right? So what we are trying to do is think about the entire, like you mentioned, the full stack of AI. So it's not just about the data centers. It's, yes, the infrastructure supporting the data centers. It's also the chips. It's also the models themselves. When you're thinking about AI, it's the entire stack of it and how you can be intentional across all of those to be able to make more of an increase in terms of capacity and decrease in terms of energy requirements and usage.
If we think about this as like a chain, where is the weakest link?
Oh, I mean, look, I think there's good ways to be intentional across all of those areas. look, the chips themselves, we're talking about in the last 15 years, a 99% increase in efficiency in chips. One of the chips that we're investing in is called the North Pole, and it's really based on the physiology of the brain. And that in of itself has shown 25 times more efficiency than the previous iterations of the chips that we had worked on. If you think about the infrastructure too, and how they can potentially be tied in terms of the processing to renewable energy or other energy sources, you can also think about every iteration of the mainframe and other infrastructure, hard infrastructure that's going into the data centers being increasingly, generation by generation, more and more efficient, tied to different sources of energy that are required. And so I think that combined with how we think about this journey of, smaller models that are much more efficient, that are really much more efficient, not just efficient, but fit for purpose, more intentional about the use cases, tying all of this together, you're really creating a much more powerful way of thinking about the computing capacity and the constraints that we're currently facing.
I have to say I did a quick Google search, so forgive me for my basic knowledge.
Did you use the AI part of the Google search, or did you use old school?
I did not, but I was intrigued when you said North Pole, physiology of the brain. I was like, wait, what? And so my understanding, co-locates memory and processing and the connections between neurons, inspired by the brain. North Pole tightly couples memory with the chip's compute units and control logic, leading to a massive 13 terabytes per second on chip memory bandwidth. Did I get it right?
Incredible, right?
Okay.
I mean, look, I'm not going to be the technical expert to speak to all of the ins and outs of that particular model, but the fact of the matter is there are some amazing investments in research and technology that are happening across, as I mentioned, the entire stack, the chips being one of them. And how cool is that? It's being, kind of built off the physiology of how we think about our brain mass.
It's just kind of, it was, the elephant in the living room. I had to go there. Having said that, though, Christina, when you talk about, more productive chips, more efficient chips, what does that mean, though, in terms of energy demand? I did moderate this panel about a week ago, and it was with the Nuclear Energy Institute, and it was about, how power demand, which hasn't really moved for a long time, has now increased dramatically over the last year or so, and the forecasts continue to see that growth. So are these chips, which increasingly are needed, efficient enough, productive enough to kind of outpace that overall growth in demand? Because it sounds like no.
Yeah, I think, to be honest, I think the innovation needs to continue, right? And so there's continued technological innovation. Is it going to solve all problems at this current moment? No. But I think going forward, the fact that there is this increased innovation across all the different areas of the technology that affect how we think about capacity constraints and infrastructure for AI, we will get there. And look, I give you an example for the AI-specific chips and infrastructure. We had set up a set of accelerators of these chips that were installed at the University of Alabama in Huntsville, which is just down the road from the NASA Marshall Space Center. Mm-hmm. And why that's relevant is that we have a partnership with NASA. We have built these geospatial foundation models. This set of AIU accelerator chips that were installed there for Gen AI experiments was incredible because we were able to do a lot of the climate and geospatial testing of these models off of these chips. And just in early tests alone with these models, we saw that the cluster could run 3 times more efficiently than the commercial GPUs that are out there. So while it may not be the answer to all things at the moment, we're seeing that there is increased acceleration of the innovation that goes into how we can solve this problem for the medium to longer term.
Yeah.
Christina, Carol and I have spent a lot of time over the last few weeks playing with ChatGPT. Is that your only Is that what you're...
That's the only one I've played around
with.
You're
not like a Gemini person yet.
I haven't gone there, and I haven't paid the upgrade.
No Claude for you yet?
Stop showing off.
No DeepSeek?
No DeepSeek.
I don't know if you're allowed to use DeepSeek.
I don't know that I am either. I'm not actually sure I'm allowed to use it here. I have to use it on my phone.
Yeah, so it does raise the question, though. So we've been doing, we're not power users by any means,
No.
but I love to, when we talk to people like you, to have you lay out a vision for us, because we understand what these LLMs can do. But what's the world we're going to be living in, say, 5 to 10 years, and the role AI is going to have in it?
It's funny, you say 5 to 10 years. I would say even posit a lot closer to us than that. I mean, LLMs are, I think, what people are most used to because we're already used to like Google searches. Everything is done by words. But the multimodal element is going to be huge going forward. It already is, right? The fact that you can speak to it, the fact that you can snap a picture, that it creates pictures for you. So the generative aspect from a multimodal perspective is going to be much bigger. That's going to include video. That's going to include what I mentioned about geospatial. I mean, all of these different ways of really making sense of the world and the technology making sense of things for us is going to be profound. And that, I don't think it's going to take 5 years. It's already happening now, but at a much more accelerated pace of adoption. Because as you said, the power users may be using them, but the average users may not be. I think that's where the next iteration of this will be going.
But are you concerned when you think about sustainability in particular? That's what your job is, Chief Sustainability Officer. And I'm not quite sure how you define it as we ramp up energy or try to meet the energy demand from AI and just the electrification of our world, the increased industrialization once again of our world. I mean, are we able to do it in a sustainable, greener, without harming Earth anymore than we already have?
Yeah. So, right. It's a very important question. So thank you for asking it. I think the idea is that just as much as energy efficiencies has increased or improved over the last several decades, it will continue to do so. So while it is requiring an immense amount of energy and water as well for data center cooling at the current moment, because of a lot of the technological innovation, I have hope that that's actually where we will be able to manage some of and mitigate for the environmental footprint. And I said before too, and I'll say it one more time, that the intentionality of how we think about using AI is really important. So how you think about what chips you're using and how energy efficient those are, your infrastructure, and again, as I mentioned, is it closely tied to a data center that's using renewable energy versus oil and gas? That will make a huge difference as well. And also the size of the model, right? You don't need a trillion parameter model to do anything and everything. We've seen 30-fold increases in capacity just by using smaller models, but also lowering the cost and increasing the efficiency of that as well. So I think if you're intentional across the entire stack of it, we can all be much more responsible in how we're thinking about the use of AI. For sure, it's a concern. We need to be intentional about it. And I'm hoping that, increasingly as we're working through with our partners and educating more broadly, that the average user will also as well.
Hey, you're down in Miami at the Future Investment Initiative Institute. Some big names there, including you. In addition, Safra Katz over at Oracle, Eric Schmidt of Alphabet and Google fame, Robert Smith, Stephen Ross, Marcelo Claret, Stephen Cohn, Travis Kalanick, formerly of Uber. The list continues. The list.
That was cute.
That happens when I talk about Uber. Sometimes I say Lyft. The list just continues to go on. What's the vibe there? What's the conversation? What's dominating the conversation?
Number one, incredible excitement about the opportunities to work between the world, collaborate. The Saudi Arabian government is just investing a ton in how we are collaborating together and showing that technology and these partnerships in technology are going to make significant impacts on the world in a positive way. I would say that's like first and foremost. And two, I mean, that the theme of the conference is invest with purpose. The idea being, as you mentioned, big names in the room, trillions of dollars of capital either owned or being managed by these people in one room. And the idea is, how do we make sure that we are investing with purpose, thinking about the impact that we're having, both the consequences as well as positive.
Christina, I have to just jump in because here you have, a day where city scraps diversity goals, DEI term under a Trump pressure from the White House. They came out and said that. Earlier today, Pepsi pulled back on DEI programs. I feel like there's a rethink too about maybe concerns about climate change. What confidence do you have that the build out to meet the demand is done in a purposeful way and maybe a careful way, certainly when it comes to impact on the environment? And we've just got about 30 seconds here.
Sure. Look, I can't speak to what all the other companies are doing. For us, it's still about long-term value creation for our clients and our partners. I know that I've met with many people here who feel the same way. And so we'll continue to do that. And, whether or not it's using certain categories of words or not, at the end of the day, it's about the outcomes of what we can drive and how we can make sure that we're doing that in the most responsible and ethical way. And so that's what we will continue to do.
So the value creation continues to include whether it's diversity or making sure that the impact on the environment is minimal or still sustainable. Is that fair?
That's fair. And I would say even more than that, it's not one or the other, right?
Okay.
I think one of the main things that I say is that sustainability is just as much of a business driver as anything else. It's not one or the other. And I think that's critical as part of this.
Christina, thank you so much. Appreciate it. This is Bloomberg.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Is it that time, Carol?
Oh, TikTok, yeah. That's when I usually do that. Sorry, I'm a little off today.
No, I don't think so. I'm off.
All right, today's your day to be off. I'm on.
You're
so TikTok,
on.
everybody.
You better be on.
18 minutes to go until we wrap up the
thing
trade
just
on this
fell out of
Thursday.
my ear and everything.
I know.
Yeah.
It is time for the drive to the close, folks. We want to get right to it because we love talking to Ryan Kelley, Chief Investment Officer, Portfolio Manager over at Hennessy Funds. He co-manages the Hennessy Cornerstone Midcap 30 Fund. It has returned on average nearly 22% annually, putting the fund in the 99th percentile against those in the sector, beating pretty much just about everyone in that group. That's according to our own data here at Bloomberg.
He joins us from Chapel Hill, North Carolina. As I'm reading this along with Carol, Ryan, I'm wondering if if it's a tough act to kind of follow performance such as that. Like,
no pressure, huh?
Yeah, kind of a little bit of pressure, right?
Oh, absolutely. No pressure at all. No, actually, there is not a whole lot of pressure, and I'll tell you why. This fund was conceived in 2003. The formula that it uses is actually the exact same today as it was back then. This is a fundamental quant type formula. Now, don't think of it as quantitative as in AI, just like all that you were talking about a moment ago. We're not going to need data centers galore for this type of investing strategy. But it is a formula, and it sticks to the exact same thing year in and year out. And we do, of course, have some years in which we're down. We're actually lagging a little bit this year already. But overall, the entire history of the fund, yes, it's done very well. So it actually does take a little bit of the pressure off, just knowing that you can take some of the emotion out of investing. You can stick to your formula. You can stick to your guns, even when it seems like it might not be working. Or sometimes when a stock you own has gone up. At one point, it was up 800%, and you think, well, maybe I should get rid of it. Well, there was still some more upside in that. So this is really a formula-based fund, and it kind of makes it a little easier to run.
So let's talk about the formula. What's the secret sauce? What's the quant method here?
Absolutely. The secret sauce, first of all, is actually published on our website. It's on our fact sheets. It's in our prospectus. It's everywhere. The idea is that we want to give investors a really great portfolio of about 30 companies in the mid-cap space. Now, we define mid-cap as between 1 and 10 billion. We're then looking for three main things. We're looking for earnings growth, we're looking for valuations, and we're looking for momentum. So we pick stocks that are below 1.5 times price to sales. We want earnings growth on a year-over-year basis, and we want momentum, 3 and 6 month price appreciation. And then what we do is we take that entire portfolio, whatever's left over, and sometimes there's about 150 companies if you look at the entire space, and we rank them by their best one-year performance, and the top 30 enter the fund. Now, a couple of little nuances that I think really help the fund is that we pick these 30 stocks, they go into the fund at about 3.3% each, but along the way, we only do this once a year, we let them run. So we end up reinvesting more into stocks that are doing well and investing less into stocks that aren't doing so well.
And I know the last time we talked to you, I think it was in November, you guys had done kind of the reboot and the rebalance, and only 2 stayed in that portfolio of 30. Is that correct?
That's correct, yes. Yep, that was the last time, and that's kind of typical of what the fund does. There's about a 90% turnover every year, each year, and I think the reason is that you get stocks that have had better momentum over the current year versus the last year, and that kind of makes a lot of them fall out. But we end up keeping whatever still stays in, makes the cut, and then we put new ones in as well. But at the end of the day, we end up with 30 stocks all equally weighted at about 3.3%, and then let them go from there.
I got to ask you, so which were the two that stuck around? I can't remember.
That is a good question. I can pick that up. Oh, it was MCore.
Okay.
Was one of them, and I need to figure out the other one.
Okay.
That's called a Carol Master pop quiz.
Sorry.
There we go. I know.
A couple, it's interesting now in terms of the top holdings: Peloton, Alaska, Brinker, and Newell Brands. Newell's been struggling this year, so that's an interesting one to see. But Peloton, let's start there. How did Peloton end up as the top holding?
Again, this was a situation where when we did the rebalance, and this was back in November of last year, Peloton came into the portfolio at a 3.3% position as well. We bought it all at around the, say, $5.50, $6 range. This rebalance we talk about usually takes about 2 to 3 weeks, and the stock has surged since. Certainly there's been some ups and downs, a little more volatile than some of the stocks we have in there, but that's why it's now the largest position. It's had a really nice start to this year until today. It's down a lot today. But the point is, it was trading at below 1.5 times price to sales. It really was kind of out of favor, yet it had some good momentum behind it, just enough to make the portfolio. And since that time, it's up about 70% from our entry price.
Well, and another one that you guys have in the portfolio, Brinker International, which is already up about 17% so far this year. They own Chili's and a few other chains. So that one's in the portfolio as well.
Absolutely. And that's another one. It's a typical type investment that we find. These are companies that have been around for a while. They have good products. Chili's has done, they own Chili's, Brinker does. They've done a great job of refocusing on their brand, sort of simplifying their menu, bringing customers back, and it's worked. And this type of investing, I would say, for various reasons in how the portfolio, how the actual metrics work together, ends up finding stocks that are kind of turnaround stories. We're not going to be the smartest guys in the room. We're not going to buy things before they turn because we want that momentum already to happen. But it's happened again and again, and a good example of that is that, and it can be sectors as well as individual stocks.
Right.
Energy. About 4 or 5 years ago, when energy was trading at when oil was trading at $40 a barrel, a lot of those companies were, of course, not making a lot of money at that point, but they still had a pretty low price to sales, and we at one point owned about 30% of the fund in energy stocks. Energy soared. Oil prices, hit almost 120 at one point, and then settled in around 80 or 90. And that ended up being a really, really good part of the fund. And it was an example of how an entire sector might be out of favor, different individual companies could be out of favor, and we'll see them as a turnaround story in the fund.
Yeah, Brinker International up 206% last year, up 35% in 2023, but still coming up, as you said. You look at earnings growth, valuation, and momentum in the fund. Pretty cool stuff.
Baby back ribs.
Don't you have to sing? Isn't there a song?
Not going to sing
Baby
it.
Back, isn't it? Like, Ryan Kelley, we do love getting time with you. Thank you so much for stopping by. Ryan Kelley, Chief Investment Officer, Portfolio Manager at Hennessy Funds, out there in Chapel Hill, North Carolina. Chapel Hill, North Carolina.
It's kind of a cold behind him.
Is it cold there?
It looks a little cold.
Yeah, it looks a little cold.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.